Hi, I'm Lindsay Bennett, Healthcare Finance Executive. And in today's video, I want to address what I see as one of the biggest gaps and opportunities for clinical and revenue cycle leaders to move up, and that is financial fluency. So often in the industry, people either speak the revenue cycle language or they speak the finance and accounting language, but the two don't really talk to each other. And in today's video, we're going to talk about the debt service coverage ratio, which is something that your CFO probably cares deeply about. And we're going to talk about how revenue cycle operations ultimately impact that number. I'm going to cover what it is, what the formula is, and why the formula is a little different between lenders. And then we're going to go through some very specific scenarios, like a change in the denials rate, a change in the collections percentage, a change in the days in AR. And I'm going to help you translate how that moves through the financial statements and ultimately impacts the debt service coverage ratio. If you're a revenue cycle leader, this is going to help you understand how your CFO thinks. And if you work on the finance side, then this is going to help you understand the operational levers that sit in revenue cycle that are ultimately impacting that number that you have to report and certify. The debt service coverage ratio is a measurement of the company's cash available to meet its short-term obligations. And by obligations, I mean its debt. It compares the operating income to the debt, and that is both the principal and the interest portion of the debt. Both inside the healthcare industry and outside of it, lenders use this ratio to assess a company's ability to pay its loans. In general, a debt service coverage ratio greater than 1 signals that there is enough money available to pay the principal and the interest on the loans. And one that's less than 1 is a flag that there's potentially a shortfall there. And the actual loan agreement will usually specify a debt service coverage ratio greater than 1, and the company needs to meet that obligation. A debt service coverage ratio of 1.25 means that the company has enough available money to pay its debts 1.25 times over. And when a company takes out a loan and agrees to a certain debt service coverage ratio, what they're saying is that they are going to keep the financials healthy enough to meet that ratio. Now let's talk about how this looks in practice. At the end of the year, after an audit, the finance staff is going to calculate the debt service coverage ratio using a formula that is specified by the lender. And that's an important point because I'm going to show you a couple of different examples of formulas, but each lender gets to determine their own. So what your organization uses is defined by the lender. The CFO signs an officer statement saying that they are in compliance, if they are, and that gets sent to the bank. Sometimes this is done annually, and other times they're required to do it quarterly. Now, the whole reason for this video is because the people that calculate and certify this number, which is the CFO and the controller, are not the people that operationally drive this number. And those are your revenue cycle leaders and your other leaders. This is why I've always been a fan of financial transparency and sharing the financial results with your revenue cycle leaders, because those are the people that are in a position to drive the numbers. And likewise, on the finance team side, they have to explain the numbers. So if they don't know what the revenue cycle team is doing, it's harder to explain. Okay, let's look at an example of how to calculate the debt service coverage ratio and how to interpret it. On the screen, you're looking at a statement of operations, which is also called an income statement or a profit and loss statement. And this is for a regional health system. The numbers here are expressed in thousands because that's typical of larger organizations. So on the screen here, you see that we have net patient service revenue of $200 million. Then below the revenue section, we have this expense section here where we have things like salaries, supplies, purchase services. And you'll notice that I have two of the expense line items highlighted. That's the depreciation and amortization expense and the interest expense. And the reason I've highlighted them is because we are going to add them back when we calculate this ratio. And I'll tell you why in just a moment. Then we go down here. If I subtract my expenses from my revenue, I have my operating income. And in this example, this hospital has investment income. So it has non-operating revenue in the form of investment income. That is included in some banks' calculations and it's excluded in others. So you have to pay attention to how the lender defines it. But in this example that I'm going to show you first, we're going to include it. And so our excess of revenues over expenses is $4 million. And that's also important because that number is our starting point for our debt service coverage ratio. So let's take a look at the calculation. On this tab, you can see that these numbers in green are just flowing through from that income statement that we just looked at. So we start with our excess of revenue over expenses, the $4 million bottom line that you saw on the previous tab. And then, like I mentioned before, we are adding back depreciation and amortization. Why are we doing that? The reason is because this is a non-cash item. And when I say that, what I mean is that this is simply a bookkeeping entry. It's a journal entry that we make. We don't actually write a check to a vendor for depreciation and amortization. So technically that money is available to help cover our debt. So we're going to add it back. Then you see we're also adding back the interest expense. Well, you might be wondering why, because that is a cash outflow. We do pay interest to the bank. Well, the reason that we're adding it back is because you'll see in this formula that it is already included in the denominator. And because we're taking interest into account in the denominator, we don't want to double count it. So once we've added those components back, that gives us our income that is available for debt service. So that means we've added back the non-cash items, we've peeled out the interest expense that we're going to include elsewhere, and that's going to give us our cash that's available to pay the principal and interest on this debt. So then we have to calculate the denominator. The denominator is the principal payments that are due this year and the interest payments that are due this year. And both of those numbers come off of the debt schedule. When you take out a loan, they're going to give you a schedule of principal payments that are due and the interest associated with that. So we're going to add those two pieces together, and that's going to give us our denominator. So then we're just going to take our numerator, the income available for debt service, and divide it by our annual debt service. And that is going to give us a debt service coverage ratio of 1.21 times. That means that we have enough cash to cover our debt obligation 1.21 times over. Now, the bank is going to potentially have a debt covenant or a ratio that you have to maintain. So for this example, we're going to say that that is 1.15. So in this case, our debt service coverage ratio of 1.21 covers this 1.15. It's greater than that number. So we have enough cash to cover our debt. We also have a little bit of extra cushion. So if I subtract the 1.15 required by the bank from the 1.21 that we calculated, we have 0.06 times in the form of a cushion. Now, if we wanted to know, for example, how much money we could lose or how much leeway we have before we have violated our covenant, then what we can do is we can go up here and take our actual income available for debt service, and we can subtract what we would be required to have, which is this 1.15 times the annual debt service. So the difference between those two is $1 million. And that's how much leeway we have before we hit this point and we start dropping below the number that is required. So before I show you some of the lender variations in this formula and the different ways that they adjust it to calculate it, I want to tell you how revenue cycle specifically impacts this number. So we have a couple different scenarios here. In the first scenario, let's assume that our denial rate increases by 0.6% of net patient service revenue. So if we calculate that out, that means that our income decreases by $1.2 million. So if we update that number in our formula and flow it through, our new debt service coverage ratio is 1.14 times. And that is below the threshold that we're assuming that the bank gave us in this example. So in that case, we are out of compliance with that agreement. Now, that doesn't mean that the organization has defaulted or that they didn't pay the principal and interest. That's different. But now we have fallen below the ratio that we agreed when we took out this loan. Another way that revenue cycle can impact this number is, let's assume that the accounting department and the revenue cycle department haven't really been communicating all year long. And at the end of the year, we figure out that we are under reserved for a payer, and accounting has to book an entry to catch up that reserve. Well, net patient service revenue is ultimately an estimate based on reserves. That's a topic for another video. But if they book this entry, let's say that it's going to decrease our net revenue by $1.1 million. That's going to affect our net income. And so that decrease in income is going to decrease the numerator. And again, our debt service coverage ratio has dropped down to 1.14. And again, we're out of compliance with that 1.15. A third scenario would be that we accelerate our AR. So let's say that our revenue cycle team is doing really well and we've reduced our days in AR by 8 days. So we're converting our services into cash sooner. How might that affect the ratio? Well, it doesn't, because the days in AR is the time it takes to convert it to cash, but you're really recognizing the income already. So there's no change in the income. That's already recognized when we provide the service. So because there's no change in income here and there's no change in the debt service, then the 1.21 that we calculated in our example remains unchanged. So a change in days in AR is not going to impact that number, even though it's a favorable thing. Now, in the last two examples, let's say that we are going to do a $20 million project. Then we're probably going to put together pro forma financial statements, but timing really matters in this case as it relates to the debt service coverage ratio, because in this example, let's say that the money is borrowed and we start making principal and interest payments on it, but the revenue hasn't materialized yet. So if this is a new service line or a new piece of equipment we're buying, if the revenue is not here yet, then we've increased our denominator, which is the debt service, but we don't have the income to offset that at all yet. So that makes our debt service coverage ratio drop down to 1.06. And again, we're out of compliance with our 1.15 that we've agreed to. Now, let's assume the same thing, that we have another project coming up, but let's say that the revenue is going to come in immediately. So our income has gone up by 3.5 million. Meanwhile, our denominator, or our debt, has increased by 2.3 million. And with both of those things factored in, now our new debt service coverage ratio is 1.25. So we are above that 1.15 threshold in that case. And that's why it's important, if you're planning a new service line, or if you're taking out debt to pay for, some kind of software or some kind of service, the timing of the income and the debt payments matter. And then finally, we're going to look at some of the common ways that lenders calculate this and how they differ. So the first example is the one that we already went through. That is the master trust indenture, or the standard. There's another method that takes a similar approach, but for the debt service, or the denominator, what they do is they take the maximum annual debt service for any future year. So if you think about it, a hospital or a health system or another provider might have multiple debts, and those debts might all have different repayment schedules, and they might have different amounts of principal and interest in different years. So instead of just taking the current year, using this method, we're looking out and trying to take the worst future year against the current income levels, because that's a conservative approach. And if we were to calculate it this way and assume that in a future year that the maximum annual debt service
the denominator would go up 1.5 million, then that would bring our coverage ratio down to 1.11. Now, the third method, which is common for commercial banks, is going to strip out the investment income. So we're going to take the EBITDA, or the earnings before interest, taxes, depreciation, and amortization, and we are not going to exclude the non-operating income. So if you remember that first example we went through, that hospital had some investment income, and we took that into account when we calculated it this way up here. But in this example, we're going to peel that out, and we're going to end up with 1.14 times for our debt service coverage ratio. And then the final way is there's another method that adds back lease and rent obligations and treats them as debt-like. So we won't get into that in too much detail, but just know that there's another method there, and that can give you an even different number. So you could get this number different ways. And again, I just want to emphasize what you need to do is look at the actual lender's definition.
If you're a revenue cycle leader and you don't know if your organization has any debt covenants, then you should ask your CFO. And you should also ask them to see the formula that the lender uses, because again, it's different by lender. The lender defines the formula. Here's another tip for staying in compliance with your debt covenants, and that is that you should look at your AR reserves every quarter, not just at the end of the year. Because as you saw in the calculation, if you have to book a big adjustment at year end, it can affect that ratio. If you want a copy of the spreadsheet that we went over today, you can find a link in the description. Please take a moment in the comments and let me know if there's a healthcare finance or a revenue cycle topic that you'd like me to cover. And please take a moment to like and subscribe so that you get notifications of future videos. Thank you so much for joining me today. Have a great day.